Friday the 17th of October 2014, and my name is Stephen Carras of LBS Legal. And if you're just joining us for the first time, welcome. Today we have some very important news that we wish to share with you. Some of you may already be aware that last night the SRA have made an announcement which will dramatically shift the regulatory landscape in relation to consumer credit. And so we thought it best if we were to put this together in order to give you an opportunity to understand what this means to you. I'm joined here today by Chris Kirkblythe of LBS Legal, also the CEO of LBS Legal, and he is going to take you through these changes, and hopefully you'll find it quite interesting. So it's over to you now, Chris.
Hello, and welcome to everybody. Today I'm going to discuss the changes to the way in which consumer credit activities are regulated. I'm afraid it is something of a dry topic. However, there are some very important and serious changes underway that you all do need to be aware of. Yesterday, as Stephen mentioned, the SRA published a consultation paper on consumer credit regulation, and also the Law Society yesterday updated its practice note to reflect the latest legal advice which has been given to the Law Society. Those two changes combine to create something of a regulatory nightmare. The background to all of this is that there was a perception amongst consumers, in the media and the political classes, that consumer lending was being dealt with irresponsibly. You'll have all seen the headlines around companies like Wonga and the payday lending companies of that sort. And we've all seen the headline APR rates of 3,500%, 5,000%, etc. And there was an overall feeling that the regulatory body in charge of consumer credit was not operating effectively, and that was the Office of Fair Trade and the OFT. So the decision was made to transfer regulation of consumer credit activity from the Office of Fair Trading to a much more robust regulatory body, the Financial Conduct Authority, the FCA. You may be wondering what on earth all of this has got to do with you. You're not a payday lending company and you don't offer consumer credit facilities to your clients, you may suppose. At the end of this presentation, however, you may have a different view. So what's happened? Well, this has been going on for some time, although it's just become a lot more worrying for reasons which I'll explain. Back on the 1st of April this year, the 1st of April 2014, consumer credit activity, as I say, became a mainstream financial services activity under the regulatory control of the Financial Conduct Authority. Previously, law firms who did carry out consumer credit activities did so by virtue of a group licence which was given to the Law Society by the Office of Fair Trading. And the types of consumer credit activities which were covered under that licence were things like consumer credit, credit brokerage, debt adjusting, debt counselling, debt administration, and the provision of credit information services. So that Law Society group licence no longer exists. It has been abolished. And now, as at today, if you wish to carry on any consumer credit activities, and I'll go into the definition of that further later, and if those credit activities don't fall under what is known as the Part 20 exemption, that's the Part 20 of the Financial Services and Markets Act 2000, then you're going to need to be authorised directly by the Financial Conduct Authority. You can carry out consumer credit activities right now only if one of the following applies to you. First of all, you are authorised by the Financial Conduct Authority to carry out this business. So you're either fully authorised, you're an FCA authorised and regulated business, or you've been granted interim permission to continue to operate consumer credit activities. This interim provision is a mechanism which has been set up to ease the transition for law firms across from the OFT system to the FCA system. If you've already got interim permission, then you can carry on your consumer credit activities because of that interim permission. If you don't already have it, then it's too late to apply for it, and your only option is to apply for full FCA authorization. The only other ways that you can carry out any consumer credit activity are, first of all, if you're acting in the course of contentious business which arises from a consumer credit or hire agreement, then that is exempt. And I'll talk a bit more about that later. But bear in mind that contentious business means post-issue work. So if you're doing any debt collection work, it is only the post-issue aspects of that work which are covered by this particular exemption. And lastly, you can undertake consumer credit activities which is exempt because of the Part 20 exemption under the Financial Services and Markets Act, which I'm going to explain in more detail. And consequently, that work is permitted by the SRA Financial Services Scope Rules, which you'll be familiar with already. They've existed since 2001. They haven't changed much, and they're in the SRA Handbook under the Specialist Services category. So if you're doing consumer credit activity other than by one of those methods I've just outlined, then what are the consequences? You know, what if you've got it wrong and you're doing consumer credit activity, you're not authorised by the FCA, you don't have interim permission, it's not work which is exempt because it's post-issue work, and it doesn't qualify for a Part 20 exemption. Well, the consequences if you get it wrong are quite serious. Have a look at Section 23 of the Financial Services and Markets Act, which is headed Contravention of the General Prohibition. Right, what is the General Prohibition? The General Prohibition, subsection 1 of Section 23, a person who contravenes the General Prohibition is guilty of an offence and liable on conviction, on indictment, to imprisonment for a term not exceeding 2 years or a fine or both. So it's a criminal offence to contravene the General Prohibition. And the General Prohibition is quite simply that unless you are authorised by the Financial Conduct Authority, you are not allowed to provide any financial services to consumers. It is highly likely that there are lots of law firms who are committing this criminal offence at the current time. The General Prohibition itself is contained in Section 19 of the Act. Have a look at that as well. It just says, no person may carry on a regulated activity in the United Kingdom or purport to do so unless he is an authorised person or an exempt person. Don't be confused by that term exempt person. That does not relate to solicitors. Solicitors are not exempt persons. It relates to things like appointed representatives or tied agents who operate outside of the UK. It's not relevant to you. The Part 20 exemption, which I've already mentioned, is not the same thing. It's a completely different thing. And as I say, this prohibition is referred to throughout the Act as the General Prohibition. So, solicitors are not exempt persons, but as I keep mentioning, in Part 20 of the Act, there is another exemption from the General Prohibition. You'll find details of it in Section 327 and Section 332 of the Financial Services and Markets Act. Section 327 first states that the prohibition on carrying out regulated activities will not apply if you're a member of a profession, for example, a solicitor, if you don't get any reward or advantage for carrying out the regulated activity, if the regulated activities are incidental to the provision of legal services, if you don't pretend that you're an authorised or exempt person, and if the regulated activities are of a kind specified by HM Treasury and they are the only regulated activities carried out by your firm. And if you're providing regulated activities such as consumer credit activities under this Part 20 exemption, then you can do so because your legal services business is supervised and regulated by the SRA, which for the purposes of this Act is a designated professional body. So rather than the Financial Conduct Authority regulating the sort of nominal financial services that you're involved in, the SRA is appointed as a designated professional body, and it is the SRA which regulates that part of your activity. This regime, this Part 20 exemption, I'm going to refer to for the remainder of this presentation as the exempt professional firm regime. And you'll notice that in that section 327, the requirement is that the regulated activities that you carry out are incidental to the provision of legal services. So there's going to be an incidental test, which I'm going to explain to you further. The next relevant section of the Act is section 332. And this requires the SRA, as a designated professional body, to make rules governing the conduct of financial services by solicitors. It specifies that those rules must ensure that solicitors only carry out regulated activities which arise out of or are complementary to the provision by him of that service to that client. So I've just mentioned something called the incidental test, which is contained in section 327. There's another test, the complementary test, which is contained in section 332. Confusingly, both of these terms have been interpreted differently to mean something different from one another, and also there is still a lot of discussion and debate around the correct interpretation of each of them. So it's far from clear. The regulated activities which you can carry out under the exempt professional firm regime are set out in a statutory instrument, the Financial Services and Markets Act 2000 Regulated Activities Order 2001, which should be up on your screen now, and you'll see also there's a URL address at the top, which if you want to look at those regulations, that will be where to go. These are then incorporated in turn into the SRA handbook by virtue of the SRA Financial Services Scope Rules 2001. And again, there should be a slide appearing on your screen now, which will show you where you can find those rules. The SRA Financial Services Scope Rules are fairly straightforward. They tell you in detail which kind of financial services you cannot carry out under the exempt professional firm regime. So, for example, you can't act as a stakeholder pension scheme manager. That's not something which the EPF scheme, the exempt professional firm scheme, can cater for. The rules also reiterate the basic conditions for carrying out financial services work. So, for example, they specify again that the activities must arise out of or be complementary to the legal services that you provide, and that you don't get paid for the financial services work that you do. I mean, just in terms of a very basic understanding of the regulatory regime, this whole exempt professional firm regime has its public policy rationale in the fact that solicitors don't and ought not to make money from this kind of incidental work that they do. So it's not your business It's something that you do to help clients. It's incidental to your main work. Therefore, because you don't have any financial interest in it, it's felt that there should be a nice, easy, light regulatory environment in which you can carry that work out. The moment, of course, that you do start to get paid for financial services work and it does become your business, then you're into an entirely different regulatory environment. The way in which you provide these financial services is, of course, regulated by another set of rules, and you'll also find those on your screen now, and they are the SRA Financial Services Conduct of Business Rules 2001. I'm not going to focus on those rules. They haven't changed. They've been the same for the last 13 years, and you ought already to be familiar with them. The scope rules have changed. On the 1st of April 2014, Rule 5.11 was added to the scope rules, and you ought to have a look at Rule 5.11. It relates, as you would expect, to credit-related regulated activities. I'm going to read it out to you. Where a firm carries on a credit-related regulated activity or a connected activity, it must comply with the provisions and guidance set out in Rule 1.3R of the transitional provisions in the Financial Conduct Authority's CONC, C-O-N-C, as they were in force immediately before 1st of April 2014 in relation to that activity, with any appropriate modification to take into account the coming into force of HM Treasury orders that give effect to the transfer of consumer credit regulation from the OFT to the FCA. I know it's a bit of a mouthful, but you'll notice that something new has been introduced there, CONC. What is CONC? And what is Rule 1.3R of CONC? And what does that mean for you that you have to now comply with Rule 1.3R of CONC? Well, I'll come back to CONC in a moment. It's going to feature quite heavily, I suspect, in all of our lives for some time to come. So, before I do that, just to recap, 3 keywords to remember: authorization, permission, exemption. If you're carrying out consumer credit activities, then you must be able to claim one of those 3 words. You're either authorized by the FCA, you're either permitted by the FCA under the Transitional Arrangements Scheme, or you're exempt from authorization because you're carrying out your consumer credit activity under the exempt professional firm regime. If you are none of these, if you're not authorized, you're not permitted, and you're not exempt, and you're doing any consumer credit activity, then you are committing a criminal offence. There's a bit of confusion about who the exempt professional firm regime is still open to. Obviously, if you are FCA authorised, you may not use the exempt professional firm regime at all. It's not relevant to you any longer. If you have direct authorisation, you cannot be an authorised person and exempt at the same time. It's not possible. What about if you have Financial Conduct Authority interim permission? Does that mean that you're no longer using the exempt professional firm regime? Have you moved across to the FCA authorised regime? The answer is no. You can continue to use the exempt professional firm regime until probably April 2015, maybe slightly later. So it is still available to you. If you have neither FCA authorisation or permission, which is the position that most law firms are in, then you can continue to use the exempt professional firm regime. Although we'll see to what extent that is actually true. Note again that if you haven't already applied for interim permission, then you will not be able to do so. That ship has sailed. So I mentioned this additional Rule 5.11, which has been added to the scope rules, and I mentioned the FCA's CONC. And on your screen now will be an introduction to CONC, and I want to welcome you all to the wonderful world of CONC. you will see there that it means the Consumer Credit Source Book. It's part of the Financial Conduct Authority's Handbook. It's a very significant document. Its scope, its breadth and its depth are very extensive. And on the screen you'll see just the main chapter headings, and that will give you a feel for what may be coming our way. You'll see that down the left-hand side under the column reference code, there's a whole series of chapter headings. I've clicked just on the first one of those just to give you an indication as to what lies behind this initial sort of home screen. And you'll see there, and take a moment to read there. We've got all sorts of principles, guidance, rules, and other links that you need to click through to. It's a very comprehensive regulatory source book. The reference to Rule 1.3R of CONC is also confusing, because if you look at Rule 1.3R of CONC, it's simply a definitions clause. So I don't understand why that rule has been placed into the SRA's handbook, into the scope rules. Really, I think what is meant is that the entire transitional provisions section, which again should be on your screen now, which again you'll see is very comprehensive, that it's the whole. It's clear that it's the whole of the transitional provisions that you need to be complying with now. So, if you are carrying out consumer credit activity now under the exempt professional regime, whether by way of interim permission or just carrying on without interim permission as you've always done, then provided the activity is permitted under the scope rules, you've still got to ensure that it's compliant with the conduct of business rules. Well, you've always had to do that, that's not changed. But you also have to ensure that the way in which you're carrying out that work is complying with the transitional provisions in the FCA's CONC and the associated guidance to those provisions. And this is a new regulatory burden, and it's in force now. And I suspect that the majority of firms have not managed to look through those provisions and that guidance and make sense of them. Oddly, the SRA says in its guidance that during the transitional period between the 1st of April 2014 and the 1st of April 2015, firms carrying on credit-related regulated activities will be required to comply with the guidance and other provisions listed in the transitional provisions in the FCA's CONC. The SRA then says these provisions should not impose any new obligations, as firms should already be complying with them. Well, the obvious question is, why does the SRA think that firms have long been complying with CONC? It simply is not the case in my experience or opinion. This is a new regulatory burden, it's in force now, and you need to be complying with it. Right, we're going to try to drill into what is a consumer credit activity and figure out whether or not your firm actually engages in this, carries out this kind of work. I'm going to talk about debt advice work first. So you may want to skip this bit if you don't do any debt advice work. If you're not sure, please do watch. The first thing to say about debt advice work is that if it arises from another service, so providing, for example, debt counselling to one of your matrimonial clients, then it will be exempt under the exempt professional firm regime, because it is both incidental and complementary to your legal services. It passes both the incidental test and the complementary test. So you needn't worry too much if you provide some debt counselling to clients who you are representing or acting for on other matters. But how about this? If you have a repeat client and some matters that you act for involve consumer credit activities, whereas others do not, well, the position then is that you might have passed the complementary test. It's arguable either way, and you've got to decide on a case-by-case basis not a matter-by-matter basis, a case-by-case basis. You've got to look at your entire offering to that client and decide whether or not the consumer credit activities which you provide to that client are complementary to the overall legal service which you provide to that client.